We believe that wealth is a journey and that this is your jumpstart to trading success. Hello, everybody. Welcome back. We've got a fantastic live stream for you today. You're going to want to take a lot of notes because today's guest is going to both teach and inspire you. This is a man who is consistently and substantially outperforming the market. In fact, this year, he's nearly tripled the S&P 500 so far with a 65% return year to date. But perhaps what's even more impressive about this gentleman is that he's doing it part-time. So today, very blessed to introduce you all to Stuart Chalmers. Welcome, Stu.
Thank you, Mike. Good to be here. Thank you very much. Hello to everybody from Scotland. Night time over here at the moment, so excuse the lighting.
It's all good. It's all good. So Stu, you have a holistic approach to trading. I'm curious if you could perhaps walk us through the different parts of your process and how you go about doing it. Especially because you still trade part-time and manage all this stuff, but like you're very efficient, and I'd love to hear how your process has evolved over time.
Okay. Wow. A plethora of riches to pick from there. So yeah, you're right in that I like to have a kind of holistic view of it. Picking a trade out in the market that's in tune with the current market conditions, which sectors are working, which types of trade are working at that point, and then what risk management and profit management models you need to follow within that that profile for that particular moment in time. And then how are you going to learn from that as well. So I guess my process starts at the weekends, where I look at two or three key things, but I like to look at how the investment landscape looks overall. So I take into account, it's just by looking at charts. So I look at charts like oil and bonds and stocks and various other asset classes to see where the money is actually going, and is it still in stocks or is it rotating out of stocks. I then like to look at the generic indexes. So I'll have a look at things like the S&P. I'll have a look at the Dow, that type of stuff, and then I'll hone in on the kind of ETFs that mostly mimic the types of stocks that I like to trade. So I'm a kind of small cap growth stock trader. I like to trade stocks that have a lot of momentum and a lot of potential for big moves within them. I'm not a long-term trader, and I'm an occasional intermediate-term trader. But my trading timeframes are normally in the 7 to 10 day mark for a successful trade. Sometimes that will extend out for 3 or 4 weeks, and 1 or 2 days if I'm going to cut it and get out. So really what I'm looking for at weekend time is what's working at the moment. What does it look like based on my experience? Which type of trade setups should I be looking for? So if it's kind of sideways market, ranging slightly down, then I'm going to focus more on pullback trades or moving average crossover type trades, where we're basically playing the ranges. That's probably where I'm quite at home, because I cut my teeth with trading on the London Stock Exchange and the European stock exchanges. Which, if you care to go and look at a chart of those, they've been in a sideways market for about 15 or 20 years. Basically, if you look at the 1999 highs, they're pretty much still there, and they go up and down. So that tends to hone the skills in those sort of range trade markets. But also, I particularly like to trade kind of explosive sort of breakouts from pullbacks and so on. And as you know, the kind of high tight flags probably my favourite pattern, or one of my favourite patterns, and where a lot of the big winners come from, and they tend to be the ones that are off other people's radars because they're lower down in the price scale, and essentially stocks that a lot of people don't like to trade because they're not the name of the month on Twitter or anything like that. They're the ones that will be. Once I'm out of the trade and other people that traded with me, then 3 or 4 months time, then there probably will be the growth stock name. So that's the kind of stocks I'm looking for. Some simple patterns that I trade. So that's the kind of general picture, and then I use various tools to scan a universe. I'll use a number of different scans. The tool I use is stock charts, but there's lots of other tools out there that do similar products. Like I know you use MarketSmith, and similar in nature and in terms of their scan engines. And that produces for me a list of the 4 possible sort of trade types that I take. I put that into a big list, and then I kind of glance through it and throw out any obvious duds that are in there that I'm just not interested in. And then I'll generally have a look at narrowing that down into a kind of weekly list. And I do that through 2 ways. One is I do have some automated scans that will scan the universe list and throw up potential candidates for me. That can be tricky if you're looking at flags, because scan engines are not very good at picking out flags. They're good at picking out highs and how far the move has gone. So you need to throw them in a list and then revisit that list for the next 5 weeks or so. So I keep a number of those lists, and I scan within those lists for the type of price action that I would be looking, that would put it on my radar that as a potential. And I narrow it down from that point of view. And then I'll end up with a weekly candidate list of, can vary from almost 0 stocks to 40 or 50 on a good week. So that's my kind of weekend process, I guess. I do have a little look at the sectors and stuff, and this is a fairly new thing for me, but I'm doing it about 1.5 years now, and looking at some sector analysis to further narrow the field.
So is looking at there's a lot that I'd like to pick apart, and I think that your process is brilliant, and it obviously works. I mean, I've seen it and experienced it firsthand during our deep dives. By the way, for anybody that's watching here too, Stuart is one of our coaches at Mara, and we couldn't be more blessed to have Stu as a coach. He's absolutely phenomenal, and the way that he breaks things down, and your process, it's so similar to the process that I arrived at so many years ago, just like this, filtering down into starting with the universe list and narrowing it down. I'm curious, how did you arrive at that? How did you arrive at that process?
I suppose it was kind of over the years. At the
Was
start,
it always like that?
No, I don't. And it's probably very different to what it was 4 or 5 years ago, because of refined the bits that work, and got rid of the excess that essentially might be interesting. It might take up a bit of time, but actually doesn't provide any value out of it. So I've just been refining. A lot of it started from, when I started trading, I came into a bit of an inheritance, lost what, about a third of it in the space of a few months.
Oh, wow.
Bought a ton of books, studied those books, then thought I was ready to become, the world's best trader, and that didn't work. So I kind of went through lots of different stages, trying lots of different things. But what I did kind of find during that process was what suited me as an individual, what I was comfortable with, and where my comfort zone was. And I then started to look and find the setups that were there, that suited me. So I'm primarily a pullback buyer, as you know, and I tend to buy off of certain moving averages. So when I sort of went through the books again, and there was a few that kind of inspired me to keep going and stick at it. I then,
What books were those?
do you know, the one that probably inspired me to stick at it was Jesse Stein's book. I'm trying to remember what it's called
Oh,
again.
really?
Yeah,
I'm familiar with Jesse as well.
so just the way he stuck at it and stuck through a lot of it. And that it was possible to make consistent money out of those types of stocks that I was looking at. And then there were others, obviously, the O'Neill books, and Minervini was a big influence in his, a lot of his kind of process and rules around where to buy, and what decent pivot points look like, and that sort of stuff. How, and I still use his basic rules for finding stocks is probably still one of my primary scans that throws up a lot of ideas. And then I have subsidiary scans that obviously then reinforce those ideas, because something appears on 4 of my scans, then that's pretty solid candidate for me. But yeah, they've focused my mind to stick at it, that it was possible, without specialist knowledge and tools and that type of stuff. And then it was just a kind of trial and error. A few other traders that I chatted to over the years that had an influence on me as well, primarily just around some of the way they had simplified as well. So I guess that's kind of how I got there. But it's a process of eliminating the things that didn't work for me, and where was my comfort zone? What am I happy buying?
And how did you go about finding that comfort zone? Like, what were some of the questions that you asked yourself?
So, well, a lot of it's through just doing hundreds of trades and logging, analysing the whole post-analysis piece. So when something went well, what exactly about that trade, what were the characteristics of that setup? What was the characteristics of the scan that brought that one to my attention? What were the markets doing at that point as well? And for years and years, I used to note them. I had a kind of chart of the 2 ETFs that I kind of follow, and I had a chart of them, and I had a little bar coming up from every successful trade, so that I could see what those overall indexes were doing at the time of my trades. And then I kept a kind of a notepad with a spreadsheet, I suppose it was, rather than a notepad, but an electronic journal of one sort or another. I've been through many, but that had a list of the trades, the dates, and whether they were winners or losers, and I would often scan through all those and then start to get myself in tune with. So when you see a cluster of failed trades and you see what the indexes or stroke ETFs are doing at that point, then that's a note for the future. So what was happening there at the time? I guess the other key thing, something I've noticed about many traders, is they look at patterns and they're quite good at picking out patterns.
Mm-hmm.
But they don't know even the basics around how stocks actually move and
No,
how
that's
markets
interesting.
actually work, and they don't factor that into how they're going to trade or when they take a trade or where. So that's an interesting one.
So they see the pattern, but they don't understand how the market moves. Can you tell me a little bit more about that? Well, what do you mean by
Yeah,
that?
well, if you go back in any stock that you're looking to enter, go back and look at that stock and look at how it moves. Now,
Um,
if you look at
should we look at maybe one or two of them? We could.
yeah, we can do. I'll probably explain first,
All right.
if you want. I haven't picked out any particular examples to show you, but if you look at a stock, any stock, and look at when it's actually moving up in price, it moves up in small momentum bursts. And you'll see
Right.
that those momentum bursts are either 3 days, 5 days, or 10 days generally. And that's the
Mm.
three most common patterns you'll see within a stock. And it'll momentum burst up for 3 days, and then it'll normally just relax a little bit. So you'll probably get one down day after 3 days. That's the most common. One down day and then another day where it kind of gets back above the high. I mean, that's how pivot points are formed. And that's everybody looks at these pivots and says, well, I'm going to buy the pivot. But they're not looking at how price got there and what it's going to do afterwards. So you really need to go back and look at every individual stock and just look at them, and you'll soon find out if you go back, just scroll week by week by week, and look for those moves of 3, 5, and 7 days, and you'll see the exact opposite happens when it hits in a downtrend. Hence why if you get 3 down days in a row, you should take note, because if you get number 4, then the probability is you're going to get a fifth. So is that going to take your stop out? Is it, you start building these things into your trading. Same if you're going to buy, if it's had 3 up days and you're going to buy it on day 4, what's the probability that it's going to go up on day 4? It may not, because
Hmm.
if it's exhausted its momentum move for 3 days, it may not go up on day 4. It may just sit and go sideways or even down a bit. So don't let that shake you out if that's your buy point.
Oh, that's interesting.
So and the same when you're in a trade. Then if you've entered and you're in, then you count the bar. So if you get 5-day move, expect it to come in on day 6, and adjust your stop accordingly, adjust your expectations, because if you're expecting it and it goes down, it's doing exactly to plan. It's not going to freak you out or anything. You're going to go, well, I was expecting it to come in today. It's doing
Hmm.
exactly as planned. Trade is going perfectly to plan. So it's just understanding those very basic building blocks of markets and how stocks actually move.
So how many plans do you have for trade law, or like I guess it's I I the way that we're framing the word plan, I think that it's a like plan or story, or like the how the trade could move, right? So like the way that I'm thinking of it is there's our best case scenario.
Uh-huh.
There's what I guess would be an average scenario, and then there's a worst case scenario.
Yep.
Are there other scenarios that you're thinking through, or am I thinking about this in the proper way?
Yeah, I think that there are 5 basic types of trades. I'm talking
Okay.
about long trades here, but you can flip it on its head for shorts. I don't short much, but so when you enter a trade, there's probably only one of 5 things that can happen. So the trade can either go straight down and just kind of torpedo you out, basically. It's like a just go straight down, hit your stop, and that's it. It's just a crash and burn. It can alternatively, you could enter and it could just slowly drift down and eventually stop you out. So that's scenario 2. Scenario 3 is it could just continue to go sideways. One day it's up, next day it's down, then it's up, then it's down. So you need to have a plan for if it does that. Fourth kind of thing is you get these kind of gentle waves, as I term them, but that's what you call it, a slow creep up. It just goes in that kind of, well, find the camera, but it goes in this kind of wavy motion. They're probably the hardest ones because you tend to move your stop up a bit too early, and then you get taken out as it kind of comes down again and then resumes its uptrend. Or you just get that nice kind of straight on up. It just keeps on going and going and going. So whenever I enter a trade, within the first day or two, you're looking to see what kind of trade you have. If it's a crash and burn, you're out anyway. If it's a slow drift down, then you need to deal with that in your overall trading plan. So what are you going to do? Risk exposure is a big thing for me. It's a completely separate topic from actual trade risk or portfolio risk. It's about exposure to risk. So trying to reduce your exposure to any kind of risk on a daily basis when you're entering a trade, or even when you're in a trade as well, because that's part of the profit management cycle as well as that whole risk exposure piece. So yeah, you try and have a plan for it. A sideways stock, well, how long are you going to let it go sideways? So you're not making much, you're not losing much, and you're up and down from day to day. So that's where time-based kind of decisions come into it. And then the other two are obviously what you're aiming for, whether it's slowly moving up in these kind of gentle waves that stocks tend to do, or whether you get a real climber there and it just day after day after day just goes up and up and up and up. So they're the 5 things I have in my mind whenever I enter a trade, and my plan kind of accounts for all of those without specifically maybe mentioning them. But that this is, if your plan is realistic and it's optimal, then you're going to make those calls, rather than just if you get a type 2 where it just drifts down lower and lower, rather than sitting day after day watch you get closer and closer to your stop, do something about it. Do something about it on day 2 or day 3. Don't sit there for a week and just let it drift lower. If you get one of those wavy trades and it goes up and it goes out 5 or 6% and then comes back down and dips under your stop, that's a hard thing to dips under your buy point, I should say. Hard thing to handle. It's now not the best kind of trade, but it might still work. So you could sit through that. The converse is if you get one that's an absolute winner, every day goes up. How do you maximize your profit in that? How do you keep as much on as long as possible? So you give it back.
You don't know if it's going to turn out to be one of those.
You don't always know, but that there's got to be going through your head every day. But you need to consider that when you're coming up with your trade plan.
So, well, what's one of the things that you do to hold on to the big winner?
So my trading plan, as you probably know, I like to scale out in thirds. So I'll take a third of my position size off at, depending on market conditions, 5% or 10%, increase from a buy point. I'll then, when that is doubled again, so at 10 or 20%, I'll take a third of the remaining off.
So it's not. So if you're looking at 100%, you're taking off 33, and then it's not another 33 of the original, right? Like from 100 shares, it's not 33 shares, and then another 33 shares. It's 33 shares, and then a third of the remaining 67, which
22
is
off. Yeah.
yeah. So you're left with 50% of the trade to keep going.
Yeah. 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 So I take a
Interesting.
third off and a third off, and then that essentially leaves me with half a position to run for as long as I can. And
Oh,
I'll, you know,
how
normally,
did you arrive at that strategy?
do you know, it was a lot of spreadsheet work and back testing and maths.
Hmm.
I tried all
Okay.
sorts. I do when I'm in a full green market like we were last year. For a big part of the time, particularly from early September through to mid-January, which is the time where I kind of made the most money ever. That I had changed that to 25% of or my first scale out and 25% of the remaining on my second, and left the rest running, which was like what's about 62% or something like that. You end up with as your stake that you run for as long as possible.
Mm.
So, but we've not been in that kind of market since mid-February now, so
Yeah,
a ways to go.
yeah. We'll see if things start to turn around. Like the conditions are starting to improve, but it's the market has a bit more proving to do, I
Yeah, I
think.
think it does. Yeah, it's not. I mean, there's signs of life, but it's not. It's
Yeah.
certainly nothing like some of the key points last year.
Yeah. Well, it's August 31st.
Well, yeah,
Kind of
true.
through the end of August, right?
Yeah, yeah, absolutely. And I think some of the conditions are a little bit similar, but yeah, I'm not seeing in the types of trades that I do and the scans that I do. There's still extremely low numbers,
Mm.
extremely low, and particularly where I'm looking for 100% moves in 3 months or less. There's very few of them. There's 10 or 11, I think, I'm picking up.
Mm.
That's full upside reversal days. So, back in January, we're seeing 100 of them a week, and they're practically non-existent. You get one or two. So a number of the key indicators that I look for that big explosive move stuff are just not there. So I'm trading pullbacks and sort of range breakout stuff at the moment.
Yeah, interesting. Um, your process is like so robust, and yet you're still doing this part time. How long does it take you to do all this?
Um, when I'm just doing it myself at the weekend, or if I wake up late on a Monday morning, I can do it probably in as little as half an hour.
The
But
whole thing, going through the whole universe list and all that.
yeah,
Wow.
yeah, it doesn't take that long. It's just repetitive clicking buttons on a screen. Potentially, I could get one of those little software robots and automate that as well. So I just
Hmm.
click one button and it's done for me. But yeah, it doesn't take me that long. The longest part is probably actually quickly scanning through the charts. But stock charts is great, and it has these little kind of mini charts, and you get like 50 to a page, so you can just quickly scan through them and get rid of all the stuff. So essentially, I run through them all, and I just hit the delete button for anything I don't like, and I'm left with a subset, and then there we go.
Yeah, that's fantastic. Like people will look at trading and like it's it really is something that you could do as a side business, and it's not going to take up your entire day. What would you say is the most difficult part of trading, or I guess like getting to this stage, right? Because it wasn't always, click a couple of buttons and a process that's done in half an hour.
Yeah.
Oh,
I think so there's two things that come in is, and I was prey to this at the start. I had a book of chart patterns, maybe
a book.
100 of them. The
Okay.
Bukowski book,
Yeah. You've told me about this book.
200 chart patterns in it, and I was trying to memorize them all, and I was going through each individual chart, and I would look and I go, is that a double bottom, or is it a reverse head and shoulders with a slant, or
Right.
or a donkey with a ponytail, or something. So, and really, it started to come together for me when I thought, and it was a bit of advice I saw somewhere, and I can't attribute it to anybody because I don't really remember who or where I saw it, but it was focus on one thing, master one thing, and that you see a lot of that comes in Minervini's books as well. He's all talking about mastery, but he's had 30 years to master it, and that's why he's got 40 chart patterns in his book. But you trade in part time. What can you do? Well, pick one, and just only one, and trade that for a year. And that teaches you a number of things. It teaches you patience when those patterns don't appear. It teaches you how to recognize them quickly, simply. It'll also hone your scanning and all that type of stuff. So if you're using a scan engine, you'll be able to narrow them down further and further because you're looking for that. So if it was a 21 EMA pullback or something like that, then you'll be able to narrow that down, and you'll be able to quickly look at a chart and go, yeah, that'll work, or no, that won't. So you get really efficient at that one pattern. And then if you do similar things to what I say, when you enter a trade, and just look at which type of stock you trade. If you're trading large caps, look at the SPX, and so we see what that's doing when your trades are winning and what it's doing when your trades are losing, and plot them all every day, stick it on a chart, and then all of a sudden you've now got an efficient technique for finding that one particular type of setup. And also that sometimes you ain't going to see them for 6 weeks because you're just drawing blanks on your scans or whatever, and that just teaches that patience part. And once you've nailed it and you're profitable, then you can start looking at how do I tweak it, but you can be tweaking that whilst learning a second pattern, and do that one for a year, and then do another one, and just bring them in slowly. Because William O'Neill, Mark Minervini, all these guys, they didn't start by looking at 40 or 50 different chart patterns. They started using one thing that gave them an edge in the market, and they built it up from there. And that's what everybody needs to do. Pick one thing and build on it.
It's a fantastic insight.
If you got one good trade in you, you'll always be able to make money in the market.
Yeah, if you take nothing away from this conversation, take that. And there's an entire page full of notes that I have so far, and what we've been talking for only about a half an hour so far. Well, let's see. Well, you've already answered a bunch of the questions that I had in here. Here we go. So yeah, even this. You mentioned the advice that someone that's just starting out, that's enthusiastic about their trading journey. Well, the types of things that they should do, which is like kind of focusing, narrowing on this one type of pattern. Is there any kind of common advice that you hear that people should avoid?
Ooh, should avoid.
Yeah.
Yeah. I'm not a great believer in the way that people size trades.
Really?
So from a risk point of view, I think it trips a lot of people up. So I'm not a great believer in that. I think it's not bad advice, but I just don't think it's I think it's more suitable to people that are trading at an institutional type of level and things rather than your individual trader. So, for instance, say you max risk on a trade is $100.
Okay.
Traditional wisdom would say, what you do? Oh, I've just got a bug flew past me there. It's gone in my drink, swine. So yeah, traditional thing would say if it was $1 risk, then you should take 100 shares in that. Now,
Okay.
that might end up to be quite a large position for you when you're just starting out. In fact, it might almost take up 100% of your capital, or whatever. If you've got a very tight and narrow stop. So the way I started out trading and working was defining a fixed risk per trade, which would be say $100. But if I could tighten that stop up, and with that $100, I would also have what is my maximum size per trade. So say it was 20% of my account. So that'd be a $2,000 trade, I think, if my maths is correct there. So I would just look at $2,000, and if the shares were $10 a pop, then that would be 200 shares. If they were $100 pop, it'd be 20 shares, and I'd just do it on that basis. And anything I could do to tighten that risk up would be to my benefit, because I'm still taking a size of trade. So what I end up doing is taking a position size where I've got a fixed kind of risk as well. So I define my maximum risk as the maximum stop I'm going to take. So I know what my position size is and my maximum stop that would take me to that max risk. And if I can get it in less than that, then that's money that I've just saved myself. And that goes all onto my bottom line. So I think we could talk for hours about risk management, but risk management is where you make or break your account. And it's not for the amount that you lose as the maximum, because you should very rarely lose the maximum risk. If you're people say never risk more than 1% of your capital, great, but you might see a belter of a trade and you want to risk 2% or something. Should you do it, or should you look to get in with a tighter stop so you're still only risking 1%? So the other thing I think about risk that I would say to traders that are just starting is you really need to get used to losing and the art of being profitable in a trade. With the best rule in the world and the best system in the world, you're probably going to be not much more than 50-50 if it's a long-term viable trading strategy. So half of your trades are going to lose. So, and if that's $100 for every one, that's 50 times 100, $5,000. If you manage your risk well, which is not about where you originally set your maximum, it's about managing the risk when you're in a trade. If you manage that risk well and reduce that 50% losses to $2,500, then you've just grown your account by 50%. 50%. And you could be at almost like a break-even trader and make a lot of money. And that is the thing that kills people. They put a stop in at 8% for some reason. 8%, and I looked at it, and there's no rules in trading. Is one of your kind of key messages, I think, Mike. And where was the law written that people's stops needed to be 8%? That's just nuts. So
they believe that's one of the ones that came in O'Neill's book, but yeah, well, like that rule is around the whole concept of 3-to-1 reward to risk, right? Like so, O'Neill found that There's like a bit of an echo in the background. That was weird. It seems like it's gone. But yeah. So, well, what he found was that trades tend to move in 20 to 25% blocks. So maintaining that 3-to-1 reward to risk is 7 to 8% kind of gets you there. Think
Yeah,
people take that a little too literally. I like your way of using a 5% stop in most cases better, but to find it based off of the price action.
yeah. So I mean, the reason I settled on a 5% maximum stop um, was kind of two things really. One, I thought I felt 8% and didn't get enough size on larger moves. And also, I was sick of seeing these triple-digit, 4-digit losses in my trading ledger. So I'm going to tighten that up. And the other key thing that really stuck with me, and one of those late night light bulb moments you get sometimes.
Right, right.
And I'd been reading Minervini's book, and he's got a little chart in his book about 100% winner equals 100%, and 20% winners equals 72%, whatever. But 12 5% moves is the same as having one 75% move. And that, because at the time, a lot of my trades were 1 point small x r, so 1.2 r, 1.4 r, and it was like, if I could tighten those up, those stops up to be 5%, then they will almost become 1.5 hour trades when they hit 5%. And then, given my trading history, and so for the 12 of the ones that are not that successful, they're not home runs. They're the same as getting one home run. So it's just that kind of, when you can turn that over and over, because I do take a lot of trades, but a lot less than I used to. It wouldn't be that uncommon for me to take 12 in a week, simply because it was a bit of a shotgun approach at the time, whereas I'd see all these ideas and I'd just put orders in for them all. And if they all got taken, great. But the whole point is, if you constantly getting those, every time you get that 5% win, that's you another 12th of the way there to a home run. And then you get another one, and that's another two, and that is really good for the whole mental game as well. Because these small wins, you get more small wins than you do big wins. It's just the law of nature. But you can start treating them the same as getting a home run, and you really care about them, and you protect them, and you make sure that they get to that 5%, because they're your home runs, all added together. So that was the kind of light bulb moment for me, and that was like, yeah, I want to see a trade get out to 5%. And if you went over most of my trades, you'll see the bulk of them get there. And when it's 5%, it's a winner for me, and I'm celebrating, and I'm really happy.
You have your maximum loss at 5%. Is there a minimum that you would set for a stop loss? So like if it's a 1% to your entry point, like, oh no, that's too small, that's too
No,
tight.
not
Like, is there
necessarily.
a too tight?
No, I've got there's an example that I traded tail end of last week. Joint. I don't know if you want to. So we could throw a chart up and show you, but
Oh yeah. Do you want to pull the chart up? Well, we could do that.
yeah, I'll throw a chart up of it.
Yeah, here we go.
So yeah, this is let's drag this down a bit. So this was joint, and I put a buy on open order. Basically, I just stuck an order in that triggered 2 minutes after the open at this price at 90 something, I don't know, 90.32. my plan was to put stop in at the low of the day, but I had this kind of do not cross line. So if ever I don't know where my stop is when I'm putting a trade on, I always have a kind of DNC line essentially that says, right, if it triggers below that, and I have an alert set on it, if it goes below that, then I'm out. So
Interesting. Well,
that's 2% below. But my actual stop when I got into this trade was 50 cents.
okay.
And bring up my notes. Yeah, so I picked up 300 at 90.32. My stop 50 cents below it. Scaled out 100 around about here, which is a 9-hour trade, and I scaled out 60, which gave me 17-hour on that, and it's still going. So
My
kind
goodness.
of, so you don't need to have big moves to make big R, because
No, not at all.
it's about managing that risk. So
So,
my sizing was based on a 2% stop there, but so as soon as when it just triggered, I looked at it about 10 minutes later, I went, oh great. And I put that 50-cent stop in. That to me is just as good as a win at that point, because I've literally got $150 or something as risk on that, which is like okay. And then
so
the idea is just to get as many dollars as I can out of it. So
I'm trying to wrap my head around this because this is brilliant. So you have a 50-cent stop. You were treating it as though you had 2% risk on, and meanwhile, like it was far less than that, maybe like a 0.5% of risk. So your the size, like the number of shares that you had, was still not larger than 20% of your overall
that's right.
capital.
Yeah, it's about a full size position for me, although it's a speculative one.
Mm-hmm.
So I don't know what it was, 30K or something like that. But so it's pretty much a full size position for me, but with a speculative amount of risk attached to it. So you essentially got 30K's worth of stock with $150 risk on it.
Now, when did you start taking out? Did you take out your 1R and 2R at the 2% increments from how you sized, or at that 50% marker, at that 50-cent marker? Where did you scale out?
No. I base them on percentage moves, so I think that's 5%, isn't it? It might not even be. It might be. It's two. That's 2 times my initial risk. That one, so that's 4. It's just short of 5%, and then maybe about 10% for that one.
Yeah. So you're taking.
Yeah. So
scaling out at 5% and 10%, not at.
A scale out at 5%. At the moment, we're in a red stroke yellow market or amber. So I scale out a third at 5%, a third at 10% above my buy point. And the amount of hours depends on how much risk you actually have on.
So the scale out is at 5% and 10%, but the amount of R in a 5% could vary between a minimum of 1, and it could be a maximum in this case of half a dozen.
Yeah. So, but that the whole point is managing the risk. You have to manage your risk and manage it well, and that will then allow you to make decent profits off of a fairly small move. But again, it's simple pattern. I mean, there's a pattern I trade over and over and over again, so I kind of know what I'm expecting from it. And that's what gives you the confidence in trading some of these type of moves and type of stocks.
Yeah. That's
Focus on one thing,
fascinating.
get good at it. then keep improving every time.
Um, I do want to leave some time open for questions from the audience if you have any. So if you're here and you're watching live, go ahead, type in your questions and we'll get to them. But the last question that I have for us, the time is really flying by. It was from recent memory. Can you tell us about a winning trade that you had in recent memory that you learned something significant from? Or if you didn't, if a recent winning trade hasn't taught you something significant, then maybe that it reminded you of a lesson that you've learned previously.
Yep.
And what was that lesson?
So I'll start with Mara.
Great name.
Yeah, I know, it's a good one, isn't it? So it must be one of my favourite all-time stocks. Let me set that back to auto. I'll go back to, oops, oh no, I'm going to go back to where I actually traded this stock. This was December last year.
December of last year, so December 2020. Okay.
Now, I'd been watching this stock for a while, been on my radar, but it was always a bit low. And then as soon as it popped above the kind of $4 or $5, I like to look at stocks above $4, although my scan's set at 3. I'll tell you the simple reason for that. When I looked at stocks that had made big moves over the year, and it's a good thing to do towards the end of a year, is look at stocks that have done more than 100%, 200%, and 400% moves. And you'll pick them out, but you'll see that they all have certain things in common. And one of the things that I noticed in common is the stocks tended to make a move from $2 to $4, then from $4 to $8, and about 8, then from 8 up to about the 16 mark, and then from 16 to 28 to 30 actually, and then from 30 to 50, and they go from 50 to 80, 80 to 100, 100 to 150, so on. So you can start to look at how price moves and where do you want to position yourself in that market space. I like to be either in the 4 to 8 move, but preferably somewhere in the $8 to $16 range. And for the type of stocks that I trade, you understand why, because this is a high type flag, by the way, that you're going to see. My high type flag requires 100% move in 8 weeks or less. And then when you start looking at stocks that move from $2 to $4 to 8 and all that, you'll see that they kind of high type flag, then double, high type flag, and double, and so on.
Mm-hmm.
So this is the kind of typical move that you'll get. So it goes from around about $2 here, it's all the way up to 6. And then it does the usual thing. If you're watching this on a day-to-day basis, rather than go back, you see it tightens up nicely, and then we get a range breakout. I was watching this around here. I entered quite late on this one at 588.
Mm-hmm.
And then you see very next day, boom, gap up and up, and the next day gaps up and up, and I scaled out and scaled out, and that's about a 50% move from that point. It's a 100% move in 3 days. So then you just keep going.
Scaled out twice already, and so it hit your initial scale outs, right? So did you take off that initial 5% and 10% on this one,
Yeah,
or
but that first scale out was at 40%.
the first scale out was at 40%?
It moved so quickly.
Wow.
The next one is at 75%.
Jeez.
The day afterwards. This is explosive moves. This is how you double your account in a year and stuff.
Double your account in a day or two.
Yeah, then comes back in. This is the first day that I've got down here that there's a stop. And strangely enough, my stop is based. I put it under the low of a day that closes below the 10 period moving average.
And which one is the 10 period moving average on this
The
chart?
pink
Is it
one,
the
this
green
one
one?
here. Yeah.
The purple or the
Yeah, the sort of purpley pink one.
yeah.
This one here. So that my stop's under here, and then the next day it goes again, and off go. Now we're at $24, and I chickened out of it. And I remember posting in our old stock twits room that I've got a stock that's just gone 500% in the fortnight, and it's like trying to pick a good move, and I was this thing was fluctuating up and down, and it was driving me crazy because it was going up and down about $30,000 in a day in terms of how much capital I had in it. So eventually scaled out in here, but then you see it comes back down and does the same again. So you get another high tight flag move, and there we go. And then we get another one, and eventually then it falls off. But I am kind of looking at it. But what that trade, I just traded it a week or two ago again. But what that taught me was that actually my system was kind of working. I was just late to those scale outs because I was looking at scaling out 10%. But I'm looking at when I'll maybe need to scale out when I look at this chart and I come in from work, and then it was already up 25%. So, and I thought, well, I'll just eke out a bit more, and then the next day it's up 40%. So,
Mm.
so I did adjust what I do in those situations in terms of my rules. So if something goes straight through a 5% scale out on day one, then I wait to see if it gets to 10% and then take it. So I double everything. And if it goes straight through that, I'll double it again to 20. If it
So
goes through that, I'll double it to 40 for my first one. Because you're on a winner
so
at that point, you know.
so the selling that you do is based off of manual orders, it sounds like? Or do you have a
Yeah,
resting order with your broker?
I put alerts in that ping me on my phone.
Hmm.
Um, I don't tend to use orders in the marketplace as such for taking profits. Sometimes that means I miss out on things, and other times it doesn't. So
Interesting.
towards
Well,
the
well,
tail
why do you
end,
have it set up that way? I'm just curious.
um, because I found I was losing too much money by not waiting. So if something jumps up 5% in the first hour of a day, what I would generally do is, what I do now is I'll double that and I'll look for 10%. But I will set a stop, a profit stop order under the low of that bar now. So if you see what I mean. So it takes out that 5% stop on a bar and it's sitting above that. Rather than take that profit there, I'll set a profit stop under the low of that bar and then just trail it up. Because what I'm trying to do is get out as near to the peak as possible, and that's one way I've found to sell into strength. Because if something's going up and up and up, just leave it alone, and then trail your stop up. And then if you see a red bar, first red bar of the day, I'll put a stop under there to take my profits, and that's on a
Interesting.
30-minute chart.
So on a 30-minute chart. Well, what if on the 30-minute chart because I've seen this happen recently too. And we do have a question there that came in, and we'll get to it in just a moment. But well, on a bar that let's say it blasts off, right? Like your first 30-minute bar, like it blasts off, hits the 1 hour target, but it reverses on you. Well, what do you do with that?
If my alert goes off, then yeah, the blast through it and it comes back down. I use alerts for most of my trading, so I'll set an alert just a little bit above my break-even point and let me know if it's coming back in.
Mm. So it might just end up being a scratch.
Yeah, yeah, yeah. I
Interesting.
think
Okay.
of that. I mean, my average yearly run rate is about 42% of my trades hit. The rest are either are out, and of that 42%, I would need to look at how many of those are just scratch trades or minuscule wins. But be a fair number of them, I think, at least 10%, or if not 20.
Wow. So much of our trading is uncannily similar. Like my batting average for the year right now is 42%.
Yeah. It just, I mean, it seems fairly static. Some years it's high 30s, and I mean, when things were going really well last year, I mean, if you looked at the shorter period stuff, you looked at your last quarter, then you were like 60% or something like that. It's like, wow, crushing it now.
Yeah.
But but not always. I did want to cover, and it's maybe a bit to do with the question here, but you asked me about trades that I learned a lot from, and one that I did learn a lot from is this one in Novacure.
But is this the question about losses?
Yep.
All
So
right, here it is.
I don't mind normal losses. So if a normal loss to me is just another. It's actually, I treat it as an opportunity to get into something better. Normally, if something comes down, stops me out, I think, right, great, I've got some more capital to then go back in, because I don't like to put too much on at once. So, so if something stops me out, it was obviously it wasn't a top idea, or wasn't ready to go. I never throw those losing trades away. I'll stick them on another list, because I don't want to lose a good setup just because I lost a trade. It might reset itself in 2 days, 3 days. Who knows? There was one that was Signet Jewelers or something. I traded that about 5 times in 2 weeks. I got stopped out, made a small win, stopped out again, made another small win. It kind of got back what I'd been stopped out, and then I traded it again the next day, and I finally got a decent trade out of it.
Was it given the same kind of setup, or how were you finding your way back into it?
Yeah, almost exactly the same. It was, up there. It was like a standard pullback buy that we talked about a few weeks ago. And then I bought it, and it would go up 2 days and then crash down, stop me out, never quite get to 5%. So yeah, it was just one of those frustrating names. But this Novacure trade is one I took back at tail end of July here. And I had traded this okay from a breakout in the 190s, or some, it was a little breakout thing, I think. Yeah, and in the 190s range breakout there, and it kind of got up. Anyway, I got out of this trade on this big bar, and then I thought I saw it setting up again. Tightened up really nicely here, and I thought it was going to go here. Anyway, my order got hit on a very early entry, and if I go back to this 30-minute chart, and I didn't get these 3 down candles in a row, and as I've said to you, that was a bit of a red flag to me, and they were big down candles, and then it kind of went sideways. So tail end of the day, I decided to chop the trade. So I took a hit on it. I don't know, 3 or 4% or something like that. It's not a full stop, but more or less a full stop. My stop was just tucked under that blue candle, I think. So, and the next day, well, it gapped down, and it's just got worse and worse and worse from there. If I zoom that out, I mean, this thing has gone down nearly
What is that?
5%. But on the day, my stop had still been there. I would not have got filled there. I'd have been filled somewhere in here, I would guess, because that first candle, I just kind of, what? So, that would have been a 5 or 6 hour loss for me. So, lessons learned. Trust your gut. When you see something you don't like, don't just hang on there. Get out. Yeah. The next day I was feeling like a champion, because just saw that go down. I was like, oh, I could not have cut it any closer either. I mean, I cut the trade at 5 minutes to the close. And it reinforces again. I traded this as a larger position than I should have. So I think because I'd seen the last one and I traded that at sort of a half or three-quarter size position. And I always had a rule: whatever market mode I'm in, trade biotechs at half that size because of their gappy nature and things. But anyway, I'd broken that rule, so it reminded me why I really needed to adhere to that rule. And it also reminded me of why you shouldn't be trading gappy stocks in the first place, because this thing, actually, if you look back, it's got a history of all this stuff. It's not the first time it's gapped down if you go back. So, yeah, biotechs, trade carefully. You can make a lot of money in them. You can lose a ton as well. So that was my lessons.
Great lessons, and thank you, Melissa, for the question. There was one thing that you mentioned in that was about your gut feel. I'm curious, how does that factor in to your trading? And if so, how much would you say that is gut feel important or not important? Or
I think you do have to learn to trust it, because it's very hard to quantify, because some things just prick your radar a little bit, and that sort of spidey sense that you have that this is not right or not what I was expecting, or and it just comes from looking at thousands and thousands of charts and stuff like that. But yeah, and I think when you sit and look at it, it's not right. It's normally isn't right. So I think we've had too many times where I've ignored that and regretted it, and very few times where I've ignored it and gone, thank goodness I ignored it. It tends to be on the regret side rather than anything else. So so I tend to, if I don't like the look of it but can't quite explain why, I'll normally just cut it. As you say, market's an infinite stream of opportunity.
sure
Because
is.
there'll be another trade there, and you got 30 others on your watch list. So why are you getting attached to that one? Just let it go. It's just
Great
a name.
advice too.
Yeah.
We could sit here all day and ask you more questions, but I know that it's late over there in Scotland. So, Stu, I really appreciate the time. Thank you so much, and thank you for everything that you do for our community. Again,
Yeah.
Stu
Really,
is a coach at Mara, and he gives countless value every single week on the deep dives, giving us lessons, coaching one-on-one. Hell of a guy, and I've learned so much from him, and I've learned even more here. Again, full page of notes, and I'm sure that everybody here has had plenty of notes as well. And Stu, thanks for the time.
I enjoyed it, Mike. Thank you very much. Thanks for the invite, and yeah, I'll see you in the Mara room.
All right. Take care. Have a good night.
Okay.
Thanks for coming, everybody.